All right, I'm going to bounce to Dom real quick. He asked a question after Ben and David, David with an E, excuse me. But Dom says, do you have a search for bear call spreads? Yes, we support 23 different strategies on power options, and we go into other strategies. You can see all of the strategies here: bear call credit, bear put debit, bull call debit, bull put credit. So I can just change this out, do the bear call credit. Okay. And just like any other strategy now, we go into bear call credit, we go into search, Dom, and you can toggle through the defaults there or create your own search. The last 5, 6 years or so, 4 or 5 years, what was good for the goose was not so much good for the gander. What I mean by that, Don, is the criteria that we use that were successful with bull puts that we've been using since about 2016 and so forth. Well, the market was lower left to upper right in most cases. We know what happened in 2018. 6 out of the 12 months were negative. We know what happened in 2020. We've seen some declines in 2 Septembers in a row now to the tune of 10% and almost 8.5% over a 2 to 3 week period, right? But looking for the high probability 2 weeks out in time, 85% probability stocks in a downtrend for the bear call spreads, this was not nearly successful over that same time period as the bull puts were, and that's because market conditions. But we do have defaults set up for you. The initial values, bear call number 1, similar to the default searches that are shown on power bull put credit spreads, excuse me, Don, and of course the weekly bear call credits, where we're going our preferred 2 weeks out in time. Usually would open a position on Monday, but again, didn't see as much success with this approach as we did with bull put credits. That's mostly due to the market conditions. All right, so let's go. Okay, I'm sorry. I'm going to skip to Jesus real quick. Jesus says, how can you find bull put credit spreads for stocks that price goes higher than 4% in a day? Okay, well, I don't have an average, Jesus, that you can say, hey, stock goes up 4% on average over the last 90 days. In fact, I don't think any stock does that. But just in the bull put credit spread search, any search, covered calls, naked puts if you wanted, bear call credit spreads the opposite if you wanted as well. Okay, let me just pull up the search here. It's loading the historical data right now as we're doing this in that case. Okay, so there we go. All right, Jesus, in the search, go to fundamentals. Use the filter for percentage stock change today. I can run a search for stocks that have gained at least 4% today. Of course, we're running it at the end of the day. I'm going to take the 12 results from the weekly bull put default, add in that filter for percent stock change today. Oh, okay. Nothing matches. So I'm going to take out all the technicals real quick. We're not going to look for stocks trading in an uptrend or crossing the MACD signal. I'm going to keep everything else, and that should be pretty good. 85% probability shouldn't be the issue, Jesus. Range out of the money should not be the issue. Not many stocks may have raised 4% today, Jesus. Let's take a look here. All right, so 1. Firm Holdings up 7.29 today. That was one of the losers that we had when that bull put screen we did over the last 3 months back on October 4th. So it's bouncing around a little wild. That's probably why it didn't match the criteria. I'm sorry, where was I going? I want to go to research and stock research. Yeah, so it's up 5.44% today. So that matches the criteria, Jesus. Again, under fundamentals, percentage, stock change today. Add in your required value to the existing criteria or criteria you created on your own. There we go. This is for Pierre M. And Pierre says, if you're looking for income, what is the best strategies? Covered call or cash secured puts? This is a decision that you want to make yourself. The exact answer, Pierre, is they're the same thing pretty much. They're parity trades of one another if you're comparing similar strikes, similar expirations, range in or out of the money, for example. They're identical. Okay, they are parity trades. let's just take a quick search into covered calls. The difference is going to be, Pierre, are you more aggressive and think the market's more bullish and you're looking at or out of the money covered call positions for more expected growth and speculation? Or are you just going slightly in the money, for example, looking for a good return on a 2-week or 3-week trade, for example? Is there anything I like in here? Nothing. I haven't seen Groupon in a while. That's a good, nice, even return of 2%. I'm going to stick with it. All right, so Groupon's at 23.15. If I wanted a high probability of getting assigned, still earning a 2% return in a 7 to 10 day period, I could consider selling the October 22 call for standard October 15th expiration, midpoint price of around 159. Okay, so let's take a look here. I'm going to go to the profit and loss chart. This is an in-the-money covered call where I'm not married to Groupon, Pierre. I'm hoping that it gets assigned because my goal is to make consistently this 1 or 2% return. And I'm going to get called out on the position, deliver my shares of stock, and then I'll look for a new, slightly in-the-money covered call going forward. Max profit's $44 on an investment of $21.56. So we're looking at a 2% return on the October in-the-money 22 strike covered call to hopefully have a good, strong probability of getting assigned, earning that return, and then moving on. Or we could evaluate selling the October 15th out of the money 22 strike put. But in this case, even if I get midpoint, which is going to be about 36 cents or so, 36 cents, that's going to be my maximum profit. Same strike position. It's only a 1.7% yield off of what? After the total requirement of the $2,200 for the cash secured put and the premium involved. These are parity trades. They have the exact same risk-reward profile, an investment of $21.56 or about $21.64 for the potential to make 44 cents or 36 cents, a 1.7% versus 2% return. The same strike and same expiration is a parity trade, as a similar risk reward. What you want to ask yourself now in this scenario is, remember, we had a 2% return with a covered call, $44 maximum profit. That lowered the monetary risk or the cost basis down to $21.56 roughly instead of $21.64. In this case, all things aside, I might be doing the covered call. These days now, after the commission wars, of course, that Robinhood started, I don't have to worry about the commissions so much. In the old days, I might have considered it. What am I talking about? Remember, in the covered call, or a buy right, as you're entering it, your broker may charge you a commission for buying the shares of stock and for selling a call in the old days. Whereas in the cash secured naked put, I'm just paying one option premium to sell the put. That's probably not in effect anymore on this position. Okay? Or on your strategy. But if you're comparing the same strike, in this case, to just get assigned on the covered call, make the return on a consistent basis, 1.52%, I'd go with the covered call, but each stock's going to be different. Sometimes the puts have a higher premium if you can get in at midpoint. Sometimes the covered call will be higher, as is in the case with Groupon, comparing the same strikes. Now, if your approach, Pierre, is that you want to hold the stock longer term and you're more bullish on the stock, so you're in a large amount of Groupon here. Let's just add the stock back in. And you're going to be selling out of the money calls, 25 strike. You're just trying to get 10, 15, 20 cents on a weekly basis, or maybe a little bit more. Then I would likely stay with just this approach, using the covered call position with an out of the money, looking for speculation to the upside, and constantly trying to lower the cost basis on the position. If that's your goal, if you're more bullish on the market, you're more bullish on these stocks, you're selling out of the money covered calls, hoping for some appreciation to get closer to this max 8.8% return if the stock's right at 25 in 7 days. It's a tall order, okay? But again, this is just for an example. In this case, I would not sell an in the money naked put. I would sell an out of the money naked put. And then, yes, if you got the stock put to you, Just the common approach in that case. You're selling the puts to get the stock at a better price. Your goal was to own it. The puts keep expiring. You keep selling them. Then eventually you get assigned, and now you convert it to a covered call position, either in the money if you want to be assigned or out of the money as we're showing here to keep collecting income because you wanted to own it long term. But if you're looking, you've decided that you want to do a covered call in stock XYZ trading at 50, you're already determined to sell the 47 call, always compare it to the parity trade of the 47 strike put at the same expiration. Sometimes the puts will be a higher price, and you'll want to go maybe with a naked put position instead. They're parity trades with similar risk-reward profile. If you see a higher return monetarily and percentage-wise on the put selling on your stock, maybe go with that one. If, however, the covered call is higher, stick with that one. As long as you're meeting your goals, though, it all comes out into play. Just keep in mind the covered call and naked put are essentially parity trades of one another.